Good morning and welcome to Bartlett's Fall Strategy Update. My name is Holly Mazzocca and I'm the president of Bartlett Wealth Management. I have the pleasure of joining you today for your moderation of today's conversation. Before we jump into today's dialogue with our panelists, we wanted to share the exciting news that Bartlett was recently named to both the Barron's and Forbes Top 100 RIA lists. We are excited about this accolade because it speaks volumes of the trust our clients have placed in us. So we wanted to share this exciting news with all of you here today, our clients. Thank you. In other Bartlett updates, our team gathered together in September for our annual advance. This is when we come together to connect, to share ideas, to celebrate our wins, and to plan for the year ahead. And the energy that comes out of these meetings of our entire team gathering together to think through the excitement of what's coming really inspires us to continue to push forward to improve our overall client experience and results for each of you. As a quick reminder, before we jump into today's dialogue, we will be saving time at the end for questions and answers. So please use that Q&A box at the bottom of your Zoom screen and submit those throughout the webinar. Then when we get to the end, we'll go through a few of those, and we can also follow up with you afterwards for any that we weren't able to cover. So with that, I'm excited to welcome today's panelists. Our first presenter today will be Wealth Advisor Kailyn. Kailyn focuses her attention on the financial planning side of our work, and she'll be talking through a year-end checklist as well as updates coming out of the One Big Beautiful Bill Act. Next up will be Tim Back, Bartlett's Director of External Manager Research. Tim will provide a market overview touching on performance year to date and our outlook for what comes next. Following Tim, James Lewis, our Senior Equity Research Analyst, will provide an update on the health of the consumer and how the health of the consumer is driving investment decisions. And finally, John Finkler, Head of Fixed Income Services, will dive into the Federal Reserve and the idea of how we're navigating this interest rate cycle. So with that, Kailyn, let's start it off. Given we're fast approaching year end, what should be top of mind for our clients?
Yeah, Holly, we say this every year, but it is so hard to believe that we're already in Q4 and halfway through October. And every year around this time, our Bartlett team begins reviewing a year-end checklist to make sure that we're ending the year on a strong note and positioning our clients for success in the year ahead. And this year's been no different, but the introduction of the One Big Beautiful Bill Act, or OB3 as I'll call it, has left us with no shortage of things to think about. So all of these things that I've mentioned are top of mind, along with, as I'm sure you can imagine, so many more.
Let's start with those year-end topics. What are the key action items that should be on everyone's year-end checklist?
Yeah, so I'll start with a few of the ones that are most time sensitive. So always a fun reminder, tax is a good place to start. If you filed an extension for your 2024 personal income taxes, that deadline is tomorrow, October 15th. And even though 2024 income tax returns are just now wrapping up for some folks, we're already looking ahead to put the finishing touches on tax-related items that need to be wrapped up by December 31st, 2025, so end of this year. One of the most important action items is your required minimum distributions, or RMDs. If you're subject to RMDs or from your IRA or inherited IRA accounts managed by Bartlett, our team will be reviewing your accounts to make sure that you're on track to meet these required amounts before year end. The penalties for missing these distributions can be steep, up to 50% of the undistributed amount plus ordinary income tax. So it's really important for us to make sure that we are taking care of those for you. Folks with inherited IRAs are subject to different rules based on age, type of account, and when the IRA was inherited. If you have outside accounts that should be factored in or have questions about the specifics of your situation, feel free to reach out to a member of your Bartlett team to discuss.
Kailyn, another action item that comes up at the end of the year is giving. What are the major gift-related considerations for year-end planning?
Yeah, we'll continue with IRAs as a topic, but for those who enjoy supporting charitable causes, qualified charitable distributions, or QCDs, can be an excellent way to meet giving goals. So with a QCD, you send a charitable gift directly from an IRA to a 501(c)(3) charitable organization, and you can actually use them to reduce your required annual distribution amount. So rather than get a tax deduction for your charitable gift, you're able to actually reduce what would otherwise be taxable income. The current annual limit for QCDs is $108,000 per person per year, and that amount is indexed for inflation annually. Remember that inherited IRAs are also eligible for QCDs if you're over age 70 and a half. Now, if you have charitable intent, but you aren't RMD'd or don't have an IRA, you can also give appreciated stock to charity either directly or via donor advised fund, also known as a DAF. And if you itemize your taxes, contributing appreciated stock to a DAF allows you to deduct up to 30% of your adjusted gross income. For many, what makes sense is for you to bunch contributions in high income tax years and then spread that giving over multiple years. Once a DAF is funded, I like to explain it like a charitable checking account. It's just a separate pot of money that can be used for charitable giving. Outside of giving to charities, year end is also a popular time to gift to family or loved ones. But the strategy for gifting stocks to family members is a bit different than for charitable organizations, given the different tax considerations. So we recommend, again, working with your Bartlett team to determine those best assets to gift to family versus those better suited to gift to charity.
You mentioned the changes in the tax code from the One Big Beautiful Bill Act. What should people be looking out for as they're planning for year end and then looking ahead to taxes in 2026?
Yeah, so a lot of the items that are in OB3 don't formally go into effect until tax year 2026, but there are a couple that are really relevant for us as we think about ending 2025. So OB3 made the current tax rates, which were planned to sunset on 12/31/25, permanent, or as permanent as tax law can be, and maintained the higher lifetime estate and gift exclusion of $15 million per person. One thing that I'll call out, though, is that while the federal exclusion remains high, some states like Illinois have lower lifetime estate and gift tax exclusions that may require some extra estate planning. The state and local tax deduction, or SALT, is also increasing effective 2025 from $10,000 per year to $40,000 per year, but begins to phase out at $500,000 per year of income. This deduction is slated to revert back to $10,000 in 2030. I'll also mention just briefly that there are some more complex rule changes that will go into effect in 2026, like a floor on charitable giving deductions and changes to 401(k) contributions for high earners. If you have questions about these changes or how they might affect you, again, feel free to reach out to a member of your Bartlett team to discuss in more detail.
Any final thoughts on planning topics as we look forward to year end?
One final thought, one that I think is really important to highlight, is this core thought that risk management is really central to our investment and financial planning process here at Bartlett. And it's especially relevant to us now after 3 strong years in equity markets. Our investment advisors and financial planners work together to craft a plan that manages risk. And one of the best ways that we can do that is by ensuring your portfolios are in line with asset allocation targets, while also balancing realized capital gains with an individual's tax profile. These long-term gains are taxed at more favorable rates than other types of income like dividends, interest, or wages, but we still recognize that it's never fun to pay taxes. With that said, we're still reminded of our role as risk manager and the importance of rebalancing to or close to portfolio targets. As we look to rebalance portfolios at year end, the team will also work to ensure that we have enough cash for known distributions for the upcoming year, like those RMDs that we mentioned at the beginning.
Great. Thank you, Kailyn. This is certainly a robust, very quick hit checklist of all the things we need to be looking out for as we head into year end. And I have no doubt there will be a lot more conversations coming out of today's dialogue. So with that, I want to turn next to Tim Back. Tim recently joined Bartlett as our Director of External Manager Research, and we're really excited for the creation of this new role that's really designed to continue to invest in our investment process and investment experience. So, with that, Tim gets the dubious honor of joining us here today for the strategy update. So, we'll jump right in. Tim, it's been an eventful and at times quite volatile year in the markets. Where do we stand today?
Absolutely. Thanks, Holly. I really appreciate it. Let's begin by setting the stage for what has been a remarkably resilient year for markets throughout 2025, particularly in the face of macro uncertainty on all fronts, whether it has been tariffs, fiscal or monetary policy domestically, or geopolitical tensions abroad. The first slide shows equity markets continuing their strong performance for the third consecutive year, and this is despite significant volatility early in the year around Liberation Day. Developed international and emerging markets are leading the way, up more than 20% year to date. As mentioned during the last webinar, much of this outperformance is reinforced by dollar weakness, which has boosted foreign returns and encouraged investors to diversify globally. Domestically, U.S. large caps remain leadership, up about 15% year to date. However, performance is more balanced than in prior years. Small caps led in 3Q as markets begin to price in a series of rate cuts following July's softer jobs report. From a sector standpoint, leadership has broadened as well. Growth-oriented sectors like communication services and technology continue to outperform, but we're also seeing strength in traditionally defensive areas like utilities, and even cyclical value sectors such as industrials, financials, and materials. Bond markets have performed well too, delivering mid-single-digit returns. Investors are benefiting from historically attractive coupons, while losses remain limited thanks to strong corporate fundamentals. These are driven by growing cash flows and low capital costs locked in prior to the Fed's previous hiking cycle in 2022.
We've certainly seen a powerful recovery since those April lows. As you look ahead, how are corporate fundamentals panning out at this point?
Yeah, absolutely. This is where we really have to separate the noise from the data. This chart demonstrates the strong corporate profit backdrop we have been operating in. The chart displays trailing 12-month S&P 500 earnings on a quarterly basis going back to 2023. The dark blue bars show actual earnings results, and the lighter blue bars represent consensus estimates through 2026. Both sets of bars are shown in dollars and correspond to the left-hand axis. The green dashed line illustrates a steady upward trajectory of the year-over-year earnings growth rate on the right-hand axis, with earnings projected to grow 11% in 2025 and accelerate to 17% in 2026. In addition to the headline of accelerating growth in 2026, there are a few key takeaways here. First, the market's resilient in the face of uncertainty this year has been justified given the upward trajectory of earnings results. Through the emotional ups and downs, corporate America has really found a way to deliver. Second, year-over-year earnings growth is expected to stall in the back half of this year as companies grapple with lingering trade disruptions and rising input costs. In addition, while the secular AI and data center CapEx trend continues to be the largest contributor to absolute growth, the rate of growth for the so-called Magnificent Seven, which we've discussed in previous updates and include Microsoft, Apple, NVIDIA, Tesla, Google, Amazon, and Meta, are expected to decelerate. This turbulence in earnings growth could certainly cause volatility into year-end, but a case can be made for cautious optimism as analysts anticipate a re-acceleration in earnings next year, and more importantly, a broadening of that growth beyond just the Magnificent Seven.
Tim, what will it take for this continued growth to continue in corporate earnings?
Yeah, Holly, I think for growth to continue, we'll need to see it expand beyond the concentration in the Mag 7. This chart compares year-over-year earnings growth for the Magnificent Seven in dark blue versus the remaining 493 S&P stocks in green. In 2025, most growth has been concentrated in the Mag 7, while the rest of the index shows modest growth. As we enter the third quarter earnings season, forecasts are beginning to shift. Analysts now expect earnings growth to broaden, with earnings per share estimates for the remaining 493 stocks starting to converge with and eventually outpace the Mag 7 by mid-2026. The next slide provides some context for this transition as well. Traditionally, the consumer, shown in green, has been the backbone of the U.S. economy. The far left column shows the average contribution to growth from 2000 to 2019 and is clearly dominated by the green segment. What's striking this year, as shown in the far right column, is the dark blue segment, non-residential investment. This is now the largest contributor to GDP growth in 2025. Non-residential investment is economists' fancy term for corporate investment. So far in 2025, the increased contribution from this factor has been almost entirely driven by AI spending, running at nearly 3 times the long-term average. A key assumption underlying the broadening earnings forecast discussed on the previous slide is a normalization of the long-term trend driven by a resilient consumer. As the forward-looking market's gaze shifts to 2026 and the evolving earnings backdrop, we feel it prudent for clients to have balance within their portfolios and exposure to the market segments with improving fundamentals.
So, Tim, this idea of this broadening out has been a bit of a perennial storyline. What might change in 2026 to really bring this to fruition?
Certainly, consensus earnings forecasts have some volatility around them, and historically, estimates for the Mag 7 have held up, while broader market projections have tended to fall short and be revised lower as the year progressed. As we look ahead, there are 2 important catalysts that could support a more inclusive earnings backdrop in 2026. First, the administration's One Big Beautiful Bill Act has injected substantial fiscal stimulus. Companies will benefit through increased deductions for R&D and capital spending, while consumers will benefit through lower income taxes and potentially higher refunds in early 2026. Second, proposed deregulation, particularly in financial services, could boost liquidity and help lower rates by increasing demand. This fiscal support, combined with easier monetary policy, which John Finkler will cover shortly, should benefit sectors outside of technology, including industrials, financials, and consumer discretionary.
So these are important tailwinds, but there's certainly some cautionary flags out there as well. One we talk about quite a bit is valuation. How are you looking at valuation metrics right now?
Yeah, valuations are definitely one of those cautionary flags. I'd be remiss if, after covering the fundamental backdrop, I did not acknowledge the valuations across many market segments, both equity and credit, remain elevated, reflecting optimistic expectations. My final chart highlights historical valuation ranges spanning the last 20 to 30 years, depending on the asset class. The blue shaded bars show the valuation range over time. The dots represent the current reading, while the triangles represent the 5-year average valuation for each asset class. U.S. large cap equities are sporting valuations near the top end of the historical range. An important item to note is that valuations have not been a great market timing tool when you are looking at short-term results. The chart also underscores how persistently elevated these valuations have been, with trailing 5-year averages still well above the long-term multiples and only slightly below current levels. The bottom line is that the highest valuations remain concentrated in the hands of the largest and growthier pockets of global markets. As the earnings backdrop continues to evolve, future investment opportunities may increasingly lie in the diversity of the investment universe rather than in the concentrated hands of a few magnificent stocks. That's why we at Bartlett continue to emphasize balance and diversification across asset classes and market segments. We remain vigilant to ensure our portfolios are well positioned to navigate an uncertain market environment.
Tim, thank you for that deep dive. And as I think about what we just heard from you, it really does depend on the health of the consumer as we look forward in this idea of broadening out beyond a concentrated part of the overall markets. James, let's turn now to you and talk a little bit more about the U.S. consumer. How are you thinking about the consumer and in turn the overall health of the economy?
Yeah, Holly, these are obviously issues that have certainly been on the forefront of my mind. Keep in mind, movements in the stock market, well, they've been historically driven by the health of the economy. As Kailyn said and Tim has said, we at Bartlett, well, we're focused on building all-weather portfolios and strategies that balance risk with opportunities. So let's getting back to the consumer. Historically speaking, 70% of U.S. GDP growth has been driven by consumer spending. While Tim pointed out that 2025 has been an outlier, a different story, where that is focused on business and investment spending on AI, it is still crucial to recognize the importance of a healthy consumer when talking about future economic growth. So with that point, many factors, economic, psychological, and social, drive consumer spending growth. One major influencer of spending growth is disposable income. For most Americans, the main contributor to disposable income is employment. Think about it this way. Job and job security not only impact the ability to spend, but also the psychological willingness to spend. Employment provides the income needed to support consumption, while job security influences the confidence needed to spend. So let's take a look at the job market, looking at using the economic indicator non-farm payrolls, which is a key indicator of economic health. Put simply, it measures jobs added or lost, excluding the seasonality associated with farm employment. The change in non-farm payroll is represented by the blue bars. The dotted green line shows the long-term average of 130,000 jobs added per month since 1950. So going back to 2022, as this chart displays, the job market has maintained substantially above trend due to benefits of COVID-era stimulus. Since the start of 25, though, the number of jobs being added has slowed meaningfully. Economists have cited two reasons for the slowdown: tariff uncertainty and lower immigration. While the slowdown is certainly a reason for caution, determining whether this trend is simply a cool down from a hot labor market or a more meaningful slowdown, well, that remains unclear at the moment.
James, what other factors beyond payrolls are you paying attention to?
Yeah, well, as I said, job growth is critical, but there are other factors that must be considered, including productivity enhancements and wage growth. As our colleague Matt Stiff discussed in the latest strategy update, AI is beginning to drive measurable productivity enhancements as companies integrate new technologies into their operations. Walmart's a good example. They recently announced it expects to keep employment roughly flat over the next 3 years as technology advancements are progressed. The chart on the left side of this slide shows the most recent productivity reading from the Bureau of Labor Statistics. In Q2, productivity reading was 3.3%. This was well above the long-term average of 2.1%. While earlier gains have been promising, the broader economic impact of AI adoption will likely unfold gradually. Encouragingly, real wage growth has become a supporter factor for consumer spending, as indicated in the chart on the right side of the page. Private sector employees have experienced inflation-adjusted wage gains since mid-2023, following a 2-year period of declining purchasing power during the post-pandemic inflation surge. With inflation now moderating and incremental productivity gains emerging, households are beginning to see modest but steady improvements in their real incomes, and this should help sustain consumer demand even as labor markets cool.
So, James, there's been a lot of talk recently about this idea of sort of two different economies. When you think about the wealth effect and how the top 10 to 20% of income earners are really driving growth, how does this impact your views of the health of the consumer?
Yeah, I mean, it's a commonly cited concern is how bifurcated spending is amongst income groups. Here in this chart, you can see the top 20% of income earners, represented by the red line, have been basically carrying the load of consumer spending growth since 2023. Meanwhile, spending among the remaining 80% of income owners, well, that's been flat. This is primarily due to the wealth effect. Higher income cohorts have greater exposure to financial assets such as stocks and real estate. The values of these assets have appreciated considerably, bolstering household wealth and confidence. Now, contrarians question whether this trend can continue. And while we cannot predict the future, the wealth effect appears to be intact. The top 20% also possess diversified portfolios, and this should help provide protection against market drawdowns. Meanwhile, output from the remaining 80% of income owners, it's not expected to decline really meaningfully. So the bottom line is that the wealth effect is well positioned to continue fueling future consumer spending growth.
When I put those together, James, I hear we have a bit of a softer labor market, still some unknowns around inflation, yet there are opportunities for productivity employments and certainly some heavy lifting from those high income earners. Given these dynamics, are there certain sectors or stocks that you like?
Yeah, sure. In the consumer space, Holly, there's a number of stocks that we like to highlight. As in my opening remarks, the American consumer, well, it's an important component to the economy. Consumer activity may slow in the short term, but it is expected to remain resilient. And that's why we at Bartlett own a diversified mix of consumer-related stocks. Our portfolios own defensive businesses complemented by some cyclical or economically sensitive names. Our defensive lineup, well, that includes TJX companies and Costco. TJX is an off-price retailer. They operate TJ Maxx, Marshalls, and Home Goods, and they basically sell name brands at lower prices than what you can find at the department store. This value proposition, well, it resonates with all demographic groups, particularly when incomes are getting squeezed. Now moving on to Costco, well, Costco product mix consists mostly of grocery-related items. The retailer also sells in bulk, which is a strong value proposition to shoppers. Costco also benefits from a membership-based business model. Membership renewal is consistently around 93% and typically unaffected by economic conditions. One last consumer stock that I like to point out, or at least highlight, is Amazon. It's a go-to business considered to be core, largely because it possesses both defensive as well as cyclical attributes. From a defensive perspective, Amazon benefits from the Prime membership model, as well as the sale of everyday goods. This provides visibility into the future of earnings growth. The economically sensitive side, well, it includes the sale of discretionary items as well as advertising. And what's really makes Amazon unique is these businesses, well, they're complemented by a presence in AI with AWS or Amazon Web Services. So looking at this, at the end of the day, these three consumer stocks align with our continued focus on building all-weather portfolios for our clients. So what does that mean? Well, it means we are well positioned whether the economy and the consumer begin to show weakness, maintain steady growth, or the most optimistic AI forecast materializes.
James, thank you for that deep dive into the consumer experience. And one part of that consumer experience is certainly the impact of interest rates. So, John, let's turn it over to you now and kick us off with an update on where we stand with the Federal Reserve and the current interest rate environment.
So, well, the Federal Reserve sits at the heart of the U.S. economy and has been in the spotlight more than ever recently. From guiding the country through slowdowns and recessions to making interest rate decisions that move markets, the Fed's actions are constantly in focus, and today is certainly no different. We're about a month removed from the Fed's first rate cut since the fall of 2024, with the potential for more cuts soon. Now, at the same time the Fed is navigating the rate cuts, it's also facing pressure from the administration, adding even more complexity to its job. So the Fed's role of keeping the economy healthy and the financial system stable is at a pivotal point. So to help illustrate the Fed in action, we can look back over the last 35 years at the federal funds rate as shown by the blue line. The shaded gray bars highlight periods of recession as defined by the National Bureau of Economic Research. As you can see, the changes the Fed makes evolve with the needs of the economy, reducing interest rates in recessionary periods and raising rates when the economy is running hot or inflation is spiking. You can look back to the dot-com bubble in the 90s. The Fed reduced rates to help with the recovery. Then, following the great financial crisis in 08-09, the Fed held rates at zero for 7 years to help stimulate the recovery. Conversely, in the years following COVID, the Fed was compelled to raise rates aggressively to combat surging inflation. Its efforts there have largely been successful, bringing inflation down from a peak of 9% to roughly 3% today. Now, with that progress, the Fed is taking a proactive stance, aiming to support the labor market before any material weakness emerges, leading to last month's 25 basis point rate cut.
So, John, as we think about interest rate policy, where do you envision rates may head from here?
The markets are forward-looking and pay close attention to estimates released by the Fed on the direction of monetary policy. The Fed's estimates are updated quarterly and illustrate where policymakers expect interest rates to be in the future. The green diamonds on the slide represent policymakers' year-end estimates, while the purple diamond marks the Fed's long-run projection of neutral, the level at which officials expect interest rates to settle once the economy is balanced. The medians suggest 2 more cuts this year, 1 cut next year, and then 1 final one in 2027. However, when you look to 2026 and 27, the range of projections among policymakers widens considerably, reflecting differing views about the path of inflation, growth, and ultimately the neutral rate. Now, it's important to remember these figures are simply estimates based on the data today, and that data can change quickly. The Fed continues to emphasize that its policy decisions remain data dependent. But even still, these projections provide a valuable window into the Fed's collective outlook and helps guide market expectations.
John, we were talking a lot about the consumer. Help us tie together why the Federal Reserve's actions and how they impact the consumer.
So adjustments to the Federal Reserve's short-term interest rates have really broad implications for the consumer and the economy, and they really influence overall borrowing costs and setting the tone for interest rates on consumer and business loans. And given the recent Fed reduction, along with the expectation of additional cuts to come, we just wanted to give a quick visual of the impacts the Fed moves can have. An easy comparison is 2021, when short-term rates were near zero, as the Fed looked to support the economy through the pandemic recovery. That rate environment kept borrowing costs at historic lows. Mortgage rates hovered around 3%, home equity lines, new car loans around 4%. Quite simply, money was cheap. Now, fast forward to today, and the landscape looks quite different, with the Fed's benchmark rate sitting around 4%. Borrowing costs across the economy remain elevated, and mortgage rates are certainly no exception. Now, while mortgage rates aren't directly tied to the Fed's policy rate, they track longer-term yields, particularly the 10-year Treasury. Even so, the Fed's actions and tone have a powerful influence on those yields. When markets anticipate higher Fed policy rates, the 10-year yield tends to rise, pushing mortgage rates higher in turn. So while the connection isn't one-to-one, the Fed's influence still extends all along the yield curve. Now, the silver lining here is that higher Fed rates have created opportunities for savers. Yields on savings accounts, CDs, money markets are much more attractive today, giving investors a chance to earn real income on cash and short-term investments. Understanding where short-term rates may be headed can help us all make more informed financial decisions. While the Federal Reserve's latest projections can have us believe some relief to borrowers is coming, these forecasts can certainly change. Now, a return to these exceptionally low levels of 2021 appears unlikely as the Fed continues to balance a cooling labor market with persistent inflation pressures.
John, you talk a lot about this idea of the Federal Reserve being data dependent. What are the key numbers that influence their decision making?
Yeah, thinking about the headlines, the shifting narratives this year can feel overwhelming and quite frankly, even scary at times. But it's important to really sift through the noise and focus on what really matters. So while the headlines grab attention, our focus and the Fed remains on the data. So there's a wealth of information to digest, but the Fed zeroes in on a few key indicators, as illustrated in this quarterly forecast. The ranges shown for each data point reflect the projections of the Fed's voting members, providing insight into the factors that guide decisions on short-term interest rates. Expectations for growth, unemployment, and inflation form the core of the Fed's considerations, with other peripheral data also influencing outcomes. As you can see, the current data points fall within, or you can see in the case of GDP above these projections. Translating this to the Fed's interest rate outlook, assuming that this data holds, the takeaway is that the Fed would feel comfortable reducing interest rates. However, any significant deviations, such as higher than expected inflation from tariffs or stronger than anticipated growth, could cause the Fed to pause or adjust its easing cycle. Because the economy is constantly evolving, these projections will change over time, and investors watch them closely, using shifts as clues as to how the Fed may adjust policy. Based on current data, we remain confident that the Fed will succeed in gradually moving short-term rates lower. This environment makes fixed income yields and returns increasingly attractive relative to cash. Now, as the Fed cuts rates, expect cash yields to decline, widening the yield gap between cash and fixed income. Overall, I think, though, this environment underscores the value of bonds in managing risk and enhancing portfolio stability.
John, thank you for that insight into where we are today and where interest rates may potentially go as we look to the future. And as we close today's conversation, before we head into Q&A, we wanted to provide just a quick summary of those main points that our panelists shared here today. So starting with the positive trends, we've certainly seen strength out of those large US-based technology companies, referred here to as the Mag 7 or the Magnificent Seven. That's where you've seen a lot of that strong earnings growth. As we look to 2026, the idea is that a resilient consumer could help broaden out earnings beyond these technology companies. Part of that is the productivity of artificial intelligence. This is going to be necessary as we do have a bit of a softer hiring market to be able to realize that growth potential. And then finally, Kailyn mentioned those growth stimulus areas from the One Big Beautiful Bill Act. For companies, this comes down to expensing for R&D costs and capital expenditures, but there's also significant tailwinds for the consumer as well from personal tax refunds that could be coming. Now, that's not to say there aren't areas of caution for us to keep an eye on, and we're mindful of these overall risks. Valuation is certainly one of those that we're going to be paying very careful attention to. I already mentioned this idea of a bit of a cooler labor market, so watching out where we go and making sure that we do still have that support from the high income consumers. And lastly, as John alluded to, we're in the early stages of this anticipated Fed rate cutting cycle. And this plays out amidst the backdrop of uncertainty. One of the questions that came in was around tariffs, which we'll touch on here in a moment. While we haven't received the question yet, another one that I've been hearing from some of my clients comes to the government shutdown. We can touch on that as well, along with some other questions that we've received here today. So with that, we will open it up for Q&A. And I'm going to start here with a question for you, James, around tariffs. Question came in from our audience. Why is it that these crazy tariff rates are being charged are not having more of an adverse effect on earnings and projected earnings? So why aren't we quite seeing that flow through from tariffs?
Oh, so it remains a headwind for consumers, but what we're seeing is retailers are pushing back on raising prices. So they're actually making the suppliers eat most of the tariffs. And in fact, Goldman Sachs came out with a report I recently read that said about 50% of the tariffs actually is being passed along to consumers. Now, that doesn't say that the Procter & Gamble's, the Colgates, and other companies are going to be passing along those tariffs to consumers, but there's the pressure of Costco, Amazon. They're really pushing back on raising prices 100% to the consumer.
So still a lot more to come when it comes to the tariff conversation. John, let's touch a little bit here on the government shutdown, just quickly, Bartlett's views on how we're paying attention to that.
Yeah, absolutely. I think as we look at this government shutdown, it's certainly different than the last government shutdown we saw just a few years ago, specifically around there is no debate this time around the debt ceiling. So funding is still taking place as it typically has and typically does. So we view this government shutdown as more noise compared to different government shutdowns that we've seen in the past. But certainly, noise does create volatility. But I think if you look at the implications around what's happening with this government shutdown, it's much different than the last one we saw. and the implications are a little bit less. But again, it doesn't mean that there's not volatility and headlines around it.
Yeah, especially as we think about the potential layoffs coming out of some of those government sectors, that's an important area to watch. Tim, here's a question that I'd like to direct your way. There's a couple of questions that have come in related to gold and cryptocurrency. Can you provide an update on Bartlett's latest thinking on these assets?
Yeah, absolutely. I mean, I'd like to set the stage, and clarify that Bartlett does not currently kind of include gold or cryptocurrency, within our asset allocation framework. But we do internally discuss these asset classes very, thoroughly from both a portfolio construction and risk management perspective. Really get understanding of the potential role and impact these asset classes could have in portfolios. Typically or traditionally, gold and Bitcoin are considered real assets as kind of designed or implemented in portfolios to hedge against geopolitical uncertainty and inflation. That's really driven by kind of a disconnect from a supply and demand perspective for these, assets, and the interlinking with the real economy. And so that disconnect really helps kind of put a deviation between the price, or a low correlation between the price and kind of public equities and fixed income. In addition, they both asset classes really lack kind of key fundamental drivers to an intrinsic value, which can also lead at times to a disconnect between a fundamental valuation and where the current marketplace lies. I think here recently you've really seen an interest in both asset classes and real assets in general, due to kind of what the markets term the debasement trade, which has really been concerns around the erosion of fiscal and monetary discipline, in the U.S. to really maintain the status of the U.S. dollar. It's been kind of driven by, policy shifts, both kind of the abandonment of cost cutting around Doge, but also the implementation of new tariffs. And even recently with the Federal Reserve's decision to kind of cut rates despite, fairly resilient labor market. I think some of these fears may be overstated, but I think the longer term trend you've seen really happening since 22 as well, where a lot of central banks, particularly in the emerging markets, has started moving away from kind of the U.S. Treasury holdings, in lieu of buying, gold as kind of that main reserve asset, or not main, but incremental reserve asset on their balance sheets. So this recent kind of policy concerns have certainly amplified that longer term trend. I think turning specifically to Bitcoin, it's important to recognize that kind of cryptocurrencies are a pretty broad spectrum, ranging from kind of newly solidified stable coins to more speculative meme coins. I think Bitcoin in general stands out as kind of a more mature and widely adopted digital asset. So certainly kind of a different animal there within the broader ecosystem of cryptocurrencies. And certainly there's been some developments that I think have helped reduce the likelihood of kind of the extreme downside, scenario, or a collapse to zero for Bitcoin. I think the one thing I would note is that doesn't mean it's not a highly volatile asset. It's had 4 drawdowns of over 50% in the last 8 years. So a lot of volatility around it. I think, it's important to recognize and, re-anchor yourself around real assets, when you're thinking about introducing them into the portfolio, to make sure that, in terms of volatility and correlation and inflation hedges, you're really getting what you anticipate getting within the portfolio by adding them. As both Bitcoin and gold at times have had a spotty track record of delivering on those results. I think it's really important in closing that as we anticipate kind of a market environment going forward, that'll be characterized by persistently high inflation and elevated interest rates, conditions that are really unfamiliar to many investors today, that, investors will continue to really scour the backdrop looking for traditional inflation hedges like gold, as well as, explore new alternatives like Bitcoin. But at Bartlett, I think our investment philosophy remains anchored in kind of fundamental corporate earnings, which we believe will also be, able to grow alongside inflation over time.
One final question here as we wrap up, John, this idea of how correlated is the Fed's lowering of short-term rates to some of those longer-term rates, that 10-year rate? And we had a question come in around mortgage rates and what investors can expect or consumers can expect from mortgage rates.
Yeah, so really what the Fed is doing here on the lowering of interest rates is really going to impact immediately the short-term portion of the U.S. Treasury yield curve. Really, what we look at for longer-term interest rates is more on expectations about where we believe inflation's moving, where we believe the U.S. economy is moving. So really, expectations are kind of guiding that longer-term view on U.S. Interest rates. And clearly, the Fed does influence the longer term rates based on what they're seeing, the projections they're putting out there, and what they're doing on the short end of the curve. But really, longer term rates, as we look at it now, what we could see moving forward is kind of those short term interest rates continuing to move a little bit lower from here in concert with what the Fed expects to be doing over the next couple of years, specifically moving short-term interest rates lower. We think as we look at longer-term interest rates like the 10-year Treasury, which really guides kind of where mortgage rates are, I think those can trade a little bit more range-bound. So I think what we might see here is more of a steeper U.S. Treasury yield curve with short-term interest rates moving lower faster than longer-term interest rates. So how that plays into the U.S. Treasury market, the U.S. housing market. I think the low mortgage rates that we saw 3, 4, 5 years ago are probably not coming back anytime soon. And as we look at the housing market and where mortgages might go from here, sure, there might be a little bit move lower. But the reality is that one of the things that we talked about in last fall strategy update was the fact that if you look at the current outstanding mortgages, there's about 22% that are at 5% or greater mortgage rates. So mortgage rates would really have to move lower from here, significantly lower, in order to kind of free up some of the headwinds that we're seeing in the housing market. And certainly supply is also playing an issue on the U.S. housing market. So keep an eye on that 10-year as you look at the 10-year and where that goes from here, and how that how the mortgage rates will react in concert to that.
Great. Thank you, John. And with that, we will wrap up today's conversation. Thank you to all of you for joining us. And we look forward to continuing the conversation from here with each of you individually. Take care.